It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome. We're going to cover a lot of great stuff today. I've got one thing I really want to touch on, though, I thought was pretty neat. I was dealing with a client last week, and it was pretty exciting. He'd been to one of my workshops, the Your Personal Bank workshop, and had, gotten a lot more information on how this concept worked. He was very positive to it and was ready to get started, got qualified, all that good stuff. And then we introduced the new product that allows the positive arbitrage option. Now, I got to explain what that is real quick because I've touched on it in a couple of the previous shows. And this is now available, and this is I think it's a first of its kind of the industry. I'm not 100% certain about that, but I'm not aware of any other product that offers this. And it was really exciting as I shared this. And by the way, if you want to learn more about it, go to yourpersonalbank.com, and you can listen to any of the previously recorded shows. Also contact us if you want more information. But, we use a personal bank tool it's a financial tool we use to maximize access to cash, to grow the money safely, get tax-favored growth, okay? And this is valuable for a lot of people. I mean, anyone who needs access to monies, which is just about everybody, no matter what, access to that money, whether whatever the situation may be, if something happened, an emergency or health issue or your business or income, anything happens, or you see an opportunity you want to take advantage of, whether it be an investor, a business owner, you want to expand your business, you see a investment you want to jump on, those kinds of things. You have access to your money without having to pay penalties, taxes, apply for loans. It's your money. So, and you can access that money. And in the past, when you're talking about a tool where you're using the fixed option, now this is, there's three ways to go about this, and I guess I should touch on this. You can access the funds. You can set up in the financial tool in terms of a fixed, an index, or a leveraged option, okay? And the fixed is the consistent, steady eddy. You have guaranteed returns. It's insured, guaranteed, and you're going to get consistent, steady returns every year on your money. Your index, of course, is based on an index, most commonly the S&P 500. The nice part is the principal is guaranteed. So if the markets go down, you don't lose money. That's a very powerful aspect. So you don't have any downside market risk. And you have the potential of double-digit returns on good market years. So you can take advantage of those upsides without the downside risk. And, it's something really worth considering and looking at. One of the things, and this isn't just not myself, the Dalbar study, which is a 30-year-plus statistical research study that comes out every year, talks about one of the major mistakes that investors make is they take on far too much risk. I see this personally in most clients that I meet with. When I sit down with them and I look at their financial situation, and look at all their statements, what I find more often than not is the vast majority of their money is subject to market risk. And what's interesting is if you look at it from a more holistic situation, step back, look at the forest from the trees, if you know what I'm trying to say, I find a lot of those people are much more stressed out than they need to be. In other words, I've been in the financial industry over 22 years, and perfect example is when the 08-09 cycle happened. At that point in time, I could walk into a house, or a client could sit down with me, or prospect, whatever, in my office, and I could tell within 30 seconds whether the majority of their money was in the market or if it was guaranteed, just by their demeanor. It was that significant, and this was nearly 100% accurate. It was that significant. Even when things are going well, like they have been. Let's face it, the market has had the all-time longest bull market run in history. There's still that underlying stress of not knowing what's going to happen in the future. Now, I'm not saying don't take on any stress. Or I'm sorry, no, we don't want it. None of us want stress. I'm not saying don't take on any risk. Okay, but what I find is, in general, most of my clients are taking on far more risk than they would prefer to do. And when I start asking them questions about why they're doing what they're doing, most of the time the answers, the responses come back is because they don't realize there's another option, that there's another way, that they could divert some of those funds to a minimal or no risk situation in terms of market risk and make their life calmer, less stressful. They just don't realize. And that's why we're here. And that's why we do the radio show. And that's why we're sharing the information out there so that people can be made aware of another option that the wealthy are fairly commonly aware of and use, and the average American doesn't and is not aware of. And it's an education thing. It's a perception thing of why the financial industry feels like, in most cases, only the wealthy should have a personal bank. A lot of advisors have that biased. Personally, I don't. If somebody says, well, if you're going to save somebody taxes, they need to make X amount of dollars more for it to make it worthwhile. I tell people all the time, look, if you make, $500,000 a year income, and we can save you 10%, for example, on your taxes, that's a big deal. If you make $100,000 a year and it can save you 10% on your taxes, that's still a big deal to that person. Who make $50,000 a year, 10% is a big deal. My point is, it's not about how much, it's about the impact. And I find in many cases the impact is even greater for the person who makes less or has less in terms of protecting their growth, protecting their upside, preventing the downside, minimizing taxes, all those kinds of things, having access to more capital. It's one of those things that's so powerful and so important. It's even more impactful for those with less oftentimes than those with more. So that's why we bring it out to everybody, because this can make a difference. It can make a huge difference. My point I'm getting at here is, what is the positive arbitrage? Well, if we focus on the fixed option, like I said, this is unique as far as I'm aware. In the past, you had fixed growth, guaranteed fixed growth rates, and when you accessed funds from a personal bank contract, you had a fixed loan rate. So currently, the rates are, there's companies paying 5-6% these days, credit, interest, some a little more, but their fees are higher, so they're really not a viable option, in my opinion. And the guaranteed interest rates right now, for most companies, are around 5%. So if you're getting paid 5 and you're earning 5, it's basically a wash. Okay, the cost of the money is it's a wash. Now, another little secret I should share with you is what a lot of people don't know. And I was with a client, and by the way, a licensed insurance agent had looked into this concept, had done a lot of research, and was completely unaware until I brought it to his attention that the loan interest rate of 5% was just the current rate. We looked into the illustration and the contract, and that was the guaranteed minimum. In other words, the rate in the future could be higher. I showed him a contract with a guaranteed fixed rate contract. Maximum was 5%. I said, look, do you want to access money from this and get charged 5% or more guaranteed, or get charged 5% or less contractually guaranteed? Obviously, that's a no-brainer. We know which one he chose. The other aspect is, the new option is with the variable loan. The variable loan allows you to access funds at the Moody's corporate bond average rate, which currently is about 3.4%. And that changes each month slowly. It's based on a 20-year average. So rates have been low for the last decade, interest rates. So it's definitely on the lower end. Even if down the road, if the Fed ever does raise interest rates again to more normal levels, it'll still take time for that average to go up. My point is this: if you access funds from it currently and use the variable rate, you would get paid 5% on money you borrowed, and it costs you 3.4%, which means you make 1.6% on money you borrowed and used and spent elsewhere for emergencies, for opportunities, whatever it may be. That's powerful. Here's the last piece of that. You can choose to change to the fixed or the variable rate each year. I told you the contractual maximum is 5%, so you'll never be higher than that, and each year you could choose whichever's lower. Imagine having a mortgage on your house where the interest rate you got charged each year was based on the fixed or variable rate, and you got to choose each year whichever rate was lower. Over a 30-year mortgage, do you think you would pay less interest? I think in most cases the answer would be yes. We're going to go into this further in the next segment. I want to help you understand this positive arbitrage is an extremely powerful tool. Banks use this. The wealthy use this. Some people try to make it more complicated than it is. I'm going to boil it down, help you understand, so you can take advantage of positive arbitrage. Contact us at Your Personal Bank for more information, and we'll see you in the next segment.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're going to talk more about positive arbitrage and show you how to make money on money you spend or money you borrow. And that's a pretty exciting concept when you think about it. But before I jump into that a little further, I want to remind everybody that we're going to be doing personal bank workshops in Chicago on January 8th and in Phoenix on January 25th. Go to yourpersonalbankworkshop.com. Sign up today. These are free events, and we're going to go dive into detail about how these work, get a chance to meet, and it would be great to show you how this can enhance your financial future. So, positive arbitrage. You know, when I make that statement, some people kind of shy away and get scared and say, gosh, that's kind of complicated. Really, it's not. Most people have used positive arbitrage in their lifetime. In other words, if you've ever bought a house, in most cases, if you've ever bought a house and had a mortgage, you've used positive arbitrage. What is that? Well, if you put, say, for example, 20% down and borrowed the rest, you're using other people's money to help purchase a property, for example. It allows you to buy more house for the dollars, obviously, because you're only putting a portion of the money down and using other people's dollars to help purchase the remainder of it. Businesses do this all the time, using positive arbitrage. Banks, corporations, you name it. Banks take deposits, as many of you know on some of the previous shows, if you can listen to on yourpersonalbank.com. I'm chairman of the board of a bank in formation currently. And by the way, it's a bit of a secret, but got some exciting news on that topic that we'll be announcing the first of the year. So my point is banks use positive arbitrage constantly. Now, you can like banks or hate them, doesn't matter, but I think we can agree that banks are savvy about money. And we can learn from them. I mean, what do banks do? They take our deposits, take those funds, then load them out for cars, houses, credit cards, whatnot, create interest, payments, basically our payments, and they're making money from our money, a positive arbitrage situation. How does positive arbitrage work with your personal bank? Well, basically, again, you're setting up an account, whether it's a fixed, indexed, or leveraged option. Again, the fixed is your consistent, steady returns, guaranteed. Index is typically based on S&P 500, which means your returns are based on what the index does. Okay, your principal is guaranteed, so you won't lose. On bad market years, you don't lose. No market risk. On the positive years, your account goes up. Depending on the type of index and how you have it structured, can depend on how much you can earn on those positive years. Good market years, you have the potential for double-digit returns typically. Okay, and there's caps, fees, and things like that. And again, I'm not here to talk about that today. That was in a previous show. Again, go to yourpersonalbank.com. I go into depth about caps, rates, and fees. And if you're looking at an index product, whether that be a life insurance or annuity product, go to that show and check it out. And it'll really help you understand how caps, rates, and fees work. Or contact us at yourpersonalbank.com. We'll be happy to share with you and explain that. It's not that complicated as some people try to make it out to be. My point is this. You have access to your cash. Your money grows. There's no penalties. There's no tax consequences if it's done correctly for accessing those funds to use for emergencies or opportunities, okay? And the key here is when you access those funds, whenever you access funds or borrow funds, you take a loan for any purpose, there's a cost, okay? And so what's the cost of the loan? Well, if we look at the fixed option, the fixed product, the benefits, again, of the fixed option is fixed guaranteed returns. Currently, 5% is what some of the best products are paying. Some are paying more. There's products out there that are paying 6 that are competitive, but not quite as good as 5 because they have higher fees. See, it's counterintuitive. People say to me, well, I got a better product. It's paying me 6. I said, yeah, but look at your cash values. You have less cash. How can a product paying you 6 have less cash than 5? It's all about fees, folks. So you got to look at the end result, not the upfront. Okay, I do this all the time with clients. Help them understand which one is going to generate more cash. Because remember, we're using this insurance tool not as a death benefit protection tool. Although it does have the death benefit protection, typically reduced to what's a traditional, typical insurance product. Remember, I always tell people, look, we're flipping it on a dime. It's a complete opposite of what most people are understanding of the use of insurance. Most people purchase life insurance for protection purposes. In other words, you want to pay the minimum amount of premium for the maximum death benefit to protect your loved ones, your business, whatever. And there's nothing wrong with that. In fact, I have some death benefit protection insurance myself because I own a business, I have a family, and I have those death benefit protection needs, as many of us do. And certainly you should take care of those needs. And if you need help in that area, we'll help you out. Gosh, you can even go online and get term insurance cheaply. That's not, take care of those needs, but that's not really what I'm here to talk to you about. I'm here to talk to you about the opposite. Again, what's a tool the wealthy typically use? How do you maximize cash? How do you maximize cash growth? How do you maximize access to that cash? And how do you do it all in a tax-favored? And I can, if you again do properly, show you how to grow and access that money income tax-free. It's one of the only tools that allows that. Financial tools, I should say. Okay? That's what I'm talking about. Maximizing cash, maximizing access to cash, maximizing growth of that cash. Okay? Now, when you access those funds, how do you access it? You could take withdrawals, which, of course, would reduce your cash, just like any account. If you have $100,000 in an account and you take 50, for example, there's 50 left, right? It's pretty simple. Your growth going forward on that particular account would be less because there's less there. You took half of it. So your growth going forward would be half, right? Here I'm talking about, though, instead of taking withdrawals, cash withdrawals, you take policy loans. Now, inherently, naturally, people resist or shy away from loans whenever possible because, naturally, we're taught this. You don't want to borrow, you don't want a loan because there's a cost for that loan and there's interest and whatnot, and you want to shy away from loans whenever possible, and I completely agree. This is the one time when there's always an exception to a rule, it seems like, right? Whenever there's a rule, what's the exception? Whatever we're talking about. Well, this is the exception to that rule in terms of loans. And the reason why is because the collateral for the loan is the death benefit. And because of that, the funds that you borrow can still be accounted for, if you will, in terms of earning interest or getting interest credits, okay? So in the past, you had the fixed options, and you still do. And currently, the best product I'm aware of currently right now is paying 5%. It's got the lowest fees, is why, which equals more cash to the client. You've got 5% interest credited. If you take the fixed interest loan, you get 5% charged on your loan, so it's a wash. It's basically you're getting paid what you get in charge. It's a wash, okay? Now, depending on how you pay it back and different things, there can be some other things involved, but to keep things simple, that's really how it works. Now, the variable loan option, again, allows you to access the funds at the current Moody's bond corporate average bond rate, which is, again, you can look it up online. It changes monthly. It's based on a 20-year average, and it's currently about 3.4%. So if you access your money at 3.4 currently, and you're getting credited 5 on the money you, remember, borrowed, spent, used elsewhere for emergency or opportunity, what's happening? You're making money on borrowed funds. By the way, you're not locked into that variable rate. That's the scary part some people have. When you take the funds and you choose the variable rate, that rate is locked for 12 months. So if it's 3.4, for example, that's what you're going to get charged for the next 12 months. And then after that point, you have the option contractually to change fixed to variable every year. The fixed is contractually guaranteed at a maximum rate of 5%, which, by the way, most personal bank type contracts, insurance contracts, do not have that fixed contractual 5% maximum. That's another key question you want to ask. What's the interest rate on when I access the funds, and what is the maximum? Most are at 5 these days, but can go up from there. You want a contractual maximum of 5, so you know you'll never get charged more than 5. And each year, basically, you can choose whichever's lower, the fixed or the variable. Think about that. What if you could do that with your mortgage? I'm going to go into this further in the next segment. Stay tuned, and stay tuned to Your Personal Bank Show every Tuesday at noon on Money Radio.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We've been talking about an exciting concept called positive arbitrage. And again, for some people it sounds complicated. It actually really isn't. It's the ability to make money on funds that are used elsewhere. So if you could borrow funds, use those monies, yet still make money on it, that's called positive arbitrage. And with Your Personal Bank tool, that is one of the options that you have the potential for positive arbitrage based on what the current interest rate structure is. Currently, some of the best products out there are paying 5% interest, like I said, or in the previous segment. Some are paying higher than that, but what you'll find, they have higher fees. So they pay you more, but they take more away, so you have less cash overall, which doesn't work. It's the bottom line. It's the end result of how much cash you have that's key. So some of the current products we're dealing with right now are crediting 5% interest with the lowest fees, so you have more cash. And you have the option of accessing those funds. And again, this is on a fixed product, not an index product. Index products have had this option in the variable for a while. The problem you have there, when you talk about using an index product, it's got a variable return. Yes, the principal is guaranteed, so in a bad market years, it will not lose money. But it also it can be a bad market year, has a zero return. There's still some fees and costs involved, so your cash could go backwards slightly. If you're borrowing against it and you have a variable rate, you can create a situation that could get yourself behind the 8 ball, if you will, and you have to come up with some more money to keep it going. That's an index universal life or an IUL product. Those are touted very commonly today as the 8th wonder of the world almost, and people think they're awesome. They have a place. They can be excellent, but they also cannot work out so well. And again, it's all dependent on what the index or the market does in determining what type of return you're going to get. Don't put all your money into that. Have some of, if somebody, one of the things I can tell people this all the time, should I do the IUL, should I do the fixed option? Should I do the index option or the fixed option? Well, if we're talking about enough dollars here, why not some of both? In other words, would it make sense to have some of the money in a fixed option, guaranteed, consistent, steady Eddie returns, while at the same time some of the other monies have the potential for those double-digit returns in good years without the market risk, without any downside market risk on the bad years? Yes, that makes a lot of sense, okay? So that's where one of my pet peeves. I get people say, you should do this, you should do that. This is great and that is bad. We've all heard that people out there touting annuities are bad, or this is bad, or pay everything off and pay off your debt, pay off your house. We've heard all those things. The reality is it depends on your financial situation, where you're at, and your goals of what makes the most sense. So should you do all of one, all of the fixed, all of the index? In many cases, the answer is no. Maybe you should do some of both. But one of the things I love about this new option we have with the fixed is it's basically taking some of the benefits of the index that had the variable loan option, the positive arbitrage situation that we could get with a fixed, built into a fixed product. So you have a fixed return. You know what you're going to get. You know what you're going to earn. And if you have a variable loan with less, that's locked in for 12 months, then you know that if you're getting credited 5 and getting charged 3.4, for example, you got a 1.5 arbitrage. You can bank on that for the next 12 months. And then you can look at the current rates. Again, it's based on the Moody's corporate bond index average. It's based on a 20-year average, so it doesn't change a lot. It might move it moves typically by hundredths of a point month to month, not even tenths of a point many times. It's a very slow-moving average. So the change a year from now probably isn't going to be significant. But even if it was, you could switch back to the fixed. You have the option to move it back and forth, whichever's lower, and each time that's locked in for the next 12 months. It takes away the uncertainty. It takes away the risk. Because not only do most people have risk in terms of their money growing because they don't really know what it's going to do next year, but when they access monies or borrow monies, okay, if you have a variable loan, you don't know what it's going to cost you in the future, do you? So you have all these uncertainties. And then another risk factor out there most people don't think about, particularly on longer-term investments like the IRA 401k world, is what's the tax rate going to be at the time you access those funds? So there's tax risk in terms of how much. So there's so many uncertainties that are into play with people's money these days. You know, they're putting money away for the long term for retirement. One, they don't know what the account's going to grow to. They don't know what it's going to earn. And then if it's in a tax-deferred type situation, IRA, 401k, etc., they don't know what the tax rate's going to be when they take it out for retirement. So you're dealing with two separate but distinct and powerful risk factors on the retirement money. Yet at the same time, you know you're going to need money in retirement, right, to live on. Well, what I say is, why not eliminate some of that uncertainty? Let's lock in some of that. One of the things I say to people all the time is this. We can calculate what your cost of living is going to be with some reasonable certainty using a cost of living adjustment and all that inflation, those kinds of things. We can determine pretty good accuracy what's going to cost you to live. And I'm talking about food, clothing, housing, the basics, right? Those are things we know we're going to need in retirement, right? We can reverse engineer, if you will, and determine how much money you need today and in a fixed guaranteed scenario to create that income down the road in retirement when you need it. My recommendation often is, don't play with that. Why would you put that at risk? You have a known need down the road. Why not lock in some certainties, some guarantees, if you will? In fact, it's like the old-fashioned pension programs that many of our parents and grandparents had. It's not commonly available these days except in the public sector. If you have a government job, you've got one of those type of pensions typically. But outside of that, those just not are very common these days. In other words, what is a guaranteed pension? It's a guaranteed amount of money that's going to come in each month when you retire. Like my mom is a retired school teacher, state of Arizona. She also retired state of Missouri, so she's one of those double dippers. And she gets a pension check every month from both states. And it increases each year based on a cost of living adjustment. Financially, she's taken care of in terms of her expenses and costs to live and do what she wants to do. She doesn't have stress in terms of worrying about what she's going to have to live on through retirement, and it'll last as long as she lives. It has those guarantees built in. Years ago, many people had those kinds of pensions, and they've all but disappeared in the private sector. So many people don't have those types of pensions, or they don't stay with a company long enough to get them. So they just don't have those types of pensions, and they're trying to create those types of scenarios with uncertainties by market risk, tax risk, and all those types of things. I'm not saying don't take on any market risk. What I'm saying is don't risk what you know you're going to need. Just doesn't seem to make sense to me. Why I need X amount of dollars in retirement, and why would I risk that knowing I'm going to need it? If you want to lock that down and get that taken care of, which can be accomplished through several different products, some life, like I said, some guaranteed life products, the fixed products, there's some annuity products that can accomplish that with some good nice writers and stuff these days. I was involved with helping create one of them recently. Those are awesome tools to guarantee and lock in that known need. And then if you want to play with the rest, do so. This isn't just coming from me. The Dalbar study I've referred to many times, 30-year plus statistical research study, echoes the same sentiment. Says one of the major mistakes that most investors make is taking on far, far too much risk. So eliminate that risk or reduce that risk or lock in what you know you're going to need so that that's taken care of. You know what that does? It reduces stress. And that's one of the biggest problems I find with people when I talk to them about their money, their finances, their situation. They're concerned, they're worried, they're stressed. And that's no way to live. Contact us at yourpersonalbank.com for more information. We'll show you how this can work for you, how to reduce the stress in your life, reduce the risk in your life, and reduce the taxes in your life. Tune in every Tuesday at noon, Money Radio, 1510 a.m.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounded third, and we're coming into home. We've talked a lot about the types of Your Personal Bank tools, the fixed, the indexed, the leveraged. We've talked a lot about positive arbitrage, how to make money on borrowed money, monies that you borrow. That's quite an interesting concept, and what it does is it enhances your returns overall. You can make more by doing that. Basically, in a guaranteed manner, if you will. If you know what you're earning and what you're getting charged, and as I explained, if you missed it, listen to the previous segments. I talk a lot about how that works. You can enhance your returns, for example, on an investment, for example. Or, you're taking care of emergencies, yet still earning money on those monies, which means you have more money down the road. And if you understand this concept, you start to understand why the wealthy continue to become wealthier and why the most middle class tend to stay there and don't ever seem to get ahead, or the situation financially just never changes. And then we also talked about reducing market and tax risk, reducing the financial risk in your life. Dalbar studies and many, many studies echo this sentiment all the time, where people take on far more risk than they're comfortable with, really, when it really boils down to it. And they're pushing. Let's face it, we're pushed into that direction. I'm not picking on financial advisors, but in most cases, they're steering people towards market-type investments that involve risk to grow a nest egg. And so they're getting pushed into more of a risk situation than people are genuinely comfortable with. And what that does is it creates risk. Like I said, you got to be, you're looking in the mirror and being honest with yourself. That's one of the things I try to do when I sit down with somebody is I really try to get them to really be honest. And I guess it's a knack I have. I've gotten very good at over the years, understanding human psychology. My wife is a postmaster's degree in human development. I've learned a lot from her, of course, over the years working with clients. When you get people just to really be honest and start asking them instead of getting told what to do. I get this all the time, too. After people meet with me, they'll say, wow, that was different. That was interesting. That was fun. I actually learned something, and you actually listened and asked me a lot of questions about me and what I want. That's a different experience. I think you'll find when I talk to people, it really is about what do you want. One of the statements I make all the time is if I could wave a magic wand, and I'm not going to guarantee I can do everything, but if I could wave a magic wand and just make your money do exactly whatever it is you want it to do, what would that be? And we start talking about that. What do you really, really want to accomplish? And when it comes down to it, like I said, I find most people want to reduce the risk they have. They want to maximize returns, of course, minimize risk, minimize taxes, and have access to money. I mean, that's like the big four. And the beauty of Your Personal Bank is it can accomplish all those four things, plus some others. Okay? And remember, with Your Personal Bank, what are we doing? We're doing completely the opposite of what most people are familiar with when it comes to an insurance tool. you say insurance, then they think of the car and the home and the auto, and they think of it as a bill, and they're like, gosh, the last thing I need is another bill. They turn off, quit listening, miss the whole point. This is not what I'm talking about. Most insurance is structured as a death benefit protection tool, as we all know. You pay the minimum premium to get the maximum death benefit. That's the goal. And for death benefit protection, that's what's important. We are doing the opposite here. We're flipping it on a dime. We're completely reversing everything that we're used to traditionally using for insurance. We are using it as a tool to maximize cash. The wealthy do this, corporations, banks. I can tell you, as a chairman of the board of a bank in formation, banks use this routinely as tier one capital, one of their major assets with many banks. What do they invest their money in? Again, you can like banks or hate them. I don't really care. But we can agree they're savvy about money, so we can learn from them. Where are they putting their money? Why are they telling us to put it in the market and invest in these stock, bond, mutual fund, diversify kind of thing? Frankly, primarily so they can charge fees. Okay? That's the facts. And again, isn't me just saying that? The Dalbar study that I keep referring to echoes that same sentiment. Okay? That statistical research study. Again, we're flipping it on a dime. It's completely the opposite of what you're used to or what most people are familiar with. And like I said, I share this all the time with people, and I love this with the I've got to give a little shout out to a client I met with this past week. It was interesting. They, like I said, they'd been to the workshop, which we, by the way, we have coming up in Chicago, January 8th, and then in Phoenix, January 25th. Go to yourpersonalbankworkshop.com and sign up today. It's free. And learn a lot more, get a chance to meet me. I'll be presenting both of those, and learn about how the personal bank concept can work for you and your family and your business and enhance your financial future. Anyway, this client, he'd been to one of my workshops I did in Vegas last year. Very positive of the idea, done the research, was excited about it, got qualified, all the good stuff. And I started sharing with him the option of the fixed and the variable loan options and the opportunity to change back and forth each year to whichever's lower. And he made a comment I thought that was interesting. He said, gosh, this is awesome, almost too good to be true. And I said to him, John, I'm just going to use John as, that's not his name, but we'll just use that. And I said, John, here's the thing. It is, and I gave him the information. Sure, here's the information, and it's in the contract. It's part of your contract. And I said, but here's the other thing. I've shared this with the fixed and the variable loan options on the radio. He'd listened to some of the previously recorded radio shows where I was sharing this information. And by the way, you can go to yourpersonalbank.com and listen to any of the previously recorded shows. And I said, here's the thing you need to understand. This isn't just me sitting across the table telling you that this is the case. Here it is in writing and contractually from the company, but also anything I share on the radio, you understand, it has to be compliance approved. This is going out to lots and lots of people, and it's kind of a high-profile kind of situation. It's not like I could share something that wasn't accurate. And these shows are compliance approved, and I know this is a little self-serving, but a little shout-out to my compliance folks. They don't get much love, typically, and I remember the days, I've been in the industry long enough before compliance existed, and then, of course, that became a reality of the financial world for all of us. And, there's been fits and starts, and, there's been periods of it where it's not been fun having to, adjust to the compliance rules. And in many cases, compliance can be an adversarial type of thing. But again, kudos, they review the shows that we do before they go on the air. And it's been a very cooperative effort. And in helping me clarify the message and making it even more accurate than, not like what I was sharing before wasn't accurate when I was public speaking and meeting with clients individually, but they've helped me clarify it even further and make the message cleaner and clearer and less apt to be misunderstood or any misrepresentation in any way. And I have to thank my compliance folks for that. So as I shared that little bit of information with this John, this client, he goes, yeah, you're right. I mean, it's not like I put something out on the radio and it not be accurate because, it'd be quickly identified as not so, plus it's compliance reviewed. He goes, you're right. So in the sales world, we all know situations and, things are said sometimes that aren't entirely accurate when somebody's sitting down one-on-one or whatever. It happens, whether it be intentionally or otherwise. We just all know that happens. I don't have that luxury here. And so what I want you to understand is what you're hearing, because I get this all the time. Gosh, I've never heard of this. Why? Again, it's shared with the wealthy typically, not the average Americans. We're trying to get the message out. We're trying to educate. Just because you haven't heard of it doesn't mean it doesn't exist. This does exist. This is real. It works. And the information we're sharing has to be accurate just by the fact that we're on the radio and the fact it is compliance approved. It has to be accurate. I don't have that luxury otherwise. It has to be as accurate as possible. So understand, look into this. If you have looked into this, look at it again, because there's been some major changes, including this variable loan option allowing for the potential of positive arbitrage that did not exist in fixed products prior, that I'm aware of, prior to now. There's been so much change and innovation that the cash values are much stronger than it used to be. There's lots more flexibility in it. There's many more situations where we can keep the money growing tax-favored, even tax-free growth and withdrawals, income tax-free if used properly, that we couldn't do even a year or two ago because of enhancements. Look at it, check it out. Contact us at yourpersonalbank.com. Attend one of our workshops. Go to yourpersonalbankworkshop.com to sign up, either in Chicago for January 8th, or in Phoenix, January 25th. And lastly, stay tuned every Tuesday at noon on Money Radio 1510 AM or 105.3 FM to learn more about Your Personal Bank.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.